There you are. You're
Yes,
back.
back. I was a little bit nervous, but I think we have lots of participants already attended. So yes, the startups are coming. Nice to see you, Rahul. Very excited to have you on today's meeting, and also excited to see you. Hope everything is fine.
Vibrant startup ecosystem, I think just like Istanbul and just like Turkey and Europe these days, I think one thing the pandemic has done is that entrepreneurs are now coming from everywhere. It's become a level playing field. You can be anywhere and you can be creating software, you can be creating companies and selling anywhere. So I think one positive thing that has come out of the pandemic this year. But let me just quickly share my screen and I'll give you a little bit more context and go from
Uh,
there.
this quick notification. I mean, we have many startups from not only Turkey but from everywhere, nearly all over the world. Please, our entrepreneurs will share now on the chat box where you are, which city and country. So let our guests see the diversification of startups, different geographies. Yes, from Bangladesh to I think from Venezuela to all other countries. Yes, Morocco. Yes, please share. Syria. So
That is fantastic to hear. I think it's great to
good.
get a very diverse crowd from all over. And, we have Bangladesh entrepreneurs particularly pitching a lot in India these days. So we met a few Bangladesh entrepreneurs because they're close by to us. But it's great to see entrepreneurs from all over the world. Again, thank you. And it's quite a privilege to be here.
So
So
let's start with you. Stage is yours. Then I will be also online and asking you questions. So your presentation will enable us to ask you more questions about the process and the content that you are going to present there.
yes, and please feel free to type your questions on the chat. I'm happy to sort of take them on, or if Barak, you want to moderate them, that's fine too.
Yes.
But the whole thing will not take more than 15, 20 minutes. I only have 4 or 5 slides, so
Okay.
I think we'll just go through them just to set some context.
For our founders, question and answer section is open. So please ask your questions, and you can also vote the best questions. So we will be able to ask them as we did it earlier sessions. Please free to ask on question and answer sessions. So that's all, and we can begin. Thank you very much, and stage is yours.
Great. So a little bit longer introduction. I think Barak gave a very sort of kind introduction, but just to put it in a little bit more context. So I'm a computer science engineer by training. So I studied computer science in college, and graduated in 1998. And I started my first company, Pine Labs, right from my college. And the way to understand Pine Labs is that it's like the square of India. If some of you may have been to the US and you may have seen, these white square sort of machines where you swipe your card, and India still has the older, swipe machines, right? When you sort of go to a restaurant, you swipe your card, or these days there are smart chips, you insert your card to pay. So Pine Labs is the largest payment company in India. If you go to a restaurant in India, you will see it everywhere. It's now about $2 billion in value. I'm not involved with the company anymore. I sold it back 10 years back, but I wrote the software. I took it to the first 100 million. So great journey for me, and right out of college. So I think so that's Pine Labs. Then my second company was GlobalLogic, and it is one of the largest outsourced product company from India. And what this company does is create software for other software companies. So, like for example, our customers were Google, Microsoft, all these Adobe, all the big tech giants, who wanted to get some part of their product development done in India. So we grew that, and that got sold for about $500 million in 2013. This was bought by a large private equity player. So I think, again, sort of a good exit. So those were two companies that I was fortunate to be a part of. And both of them today are unicorns. But when I sold them, they were not unicorns. The first one was 100 million and second one was more like half a billion. After that, I worked for Sequoia India. So I'm sure all of you, in the startup space, have heard of Sequoia. Sequoia is the storied, Bay Area firm. They're investors in some of the topmost companies of the world: Apple, Google, WhatsApp, so many others, Cisco. So Sequoia has 4 offices in the world. So they are, of course, they started in the US. They have a China office, they have an Israel office, and they have an Indian office. And these are all sort of geographies where they're very active. So I worked at their India office briefly. My companies, both Pine Labs and GlobalLogic, had an investment from Sequoia, so I had a relationship, and this also allowed me to, just look from the inside how some of these investment processes work, what people look for, how it happens, and all that good stuff. I turned full-time investor around 9 years back in 2012, and I started first investing my own money. So for the first 5 6 years, I invested my own money, which is as an angel, into 28 companies. Many of these companies died and they didn't succeed, but some of the companies became very large. So Meesho is the largest social company in India now. It's well over $1 billion again, sort of in the amount of commerce that it does and the value. Shuttl is the largest office commute company in India. So it provides a bus service, through which employees can commute to office, and they don't have to take Uber or, Ola in India. They can get a bus seat for a much cheaper price. 1mg is one of the largest e-pharmacy companies in India. So basically, if you want to order medicines online, then you can use 1mg. So these are very large successes which came out of my angel investment portfolio. And I was usually the first check in all of these companies. So they were good. Some of them I've exited, some of them I'm still there. So I think that's how I gained some investment experience. Around 3 years back, because I'd been investing my own money, I started a VC fund. So the main difference between angel and a fund is that as an angel you invest your own money, and as a fund you invest other people's money. So Leo Capital, through Leo Capital, I started investing other people's money for the last 3 years, and have been investing actively in early stage tech companies in India, Southeast Asia, India, US, and all these geographies. 22 investments have been done so far from the fund over the last 3 years. And many of these companies are early, some of them are breaking down. So we continuously look at companies. Just to give you a sense, I think every month we get about 200 new companies, that pitch to us or they approach us for funding. So there is a very active entrepreneurial ecosystem in India. So that's a little bit more detailed introduction about me. But let me jump to the topic. And I think the topic given to me was how to raise fund in early stages. And I think this is one of the most important topics for entrepreneurs, because as you start a business, you want to raise money, because you want to scale, you want to hire, good people, you want to build your product, you want to sell. And in some ways, this is one of the toughest times to raise money, because you don't have that much to show, right? I mean, these companies are 6 months old, 1 year old, 2 year old. You don't have an established market, you don't have established revenue. So how do you raise money in early stages? So I think on the next 3 slides, I'm just talking about what are the things, the key things, 3 parameters that we look for and most investors look for when they look at early stage companies. So the first parameter, one out of the 3 parameter, is the macro. And the macro stands for the environment, uh, and the question that we are trying to ask ourselves is that, can there be a company built in this space at scale in the next few years? Not whether you can build it, not, if somebody else can build it, but do we think that there is a space for a new company, in this space in the next few years, whether we are in it or not. When you break it down, then some of the things that it comes down to, and I'm sure, if you're pitching to VCs, you'll hear this a lot: market size. So market size is a very, very big factor for VCs. Like because we are looking to build large companies, right? Potentially billion-dollar companies in 6, 7, 8 years. And you can only build billion-dollar companies when your market size is very large. If it's 5 billion, 10 billion, 20 billion, you know. But if your market size is small, if it's, let's say, 200 million or 300 million, then you really cannot build a large company, because you can't be bigger than the market itself, right? So market size is a really, really important factor for VCs, and we spend a lot of time, studying market size and making sure that we are doing everything we can to get into a large market. So that is number one parameter. I would say that is number one, number two, number three parameter. 90% of the companies that we reject get rejected on market size itself, because most of the market sizes are very small. The problem statements that entrepreneurs take are very small. So this is the number one reason for rejection. Then competition, like for example, in India, we have Amazon India, which is very big. We also have a local player, Flipkart, which was bought by Walmart, which are the two large online players. So if somebody pitches to us to make one more online e-commerce company, then we know that it's really hard to build one more. There are already such large companies, multi-billion-dollar companies. How do you build one more? So you can't invest in a market where there are what we call 800-pound gorillas. If there are like big companies already in that space, how do we get into that, right? But if it's a fragmented market, there are smaller players. Those are good markets to get into because you can organize them. You can compete with the smaller players. So competition is an important one. And the third thing I would say, which is very important that we ask ourselves, is why now? Because if the markets have always been there, right? So what has changed today? What is making it possible for you to build this business today that was not there, let's say 5 years back or 10 years back, or 3 years back? So for example, like one of the things in India, that we talk about is that mobile penetration has become very big. Earlier, only 100 million people had mobile connections. Now 600 million people have mobile connections. So because 600 million people have mobile connections, they can access internet. You can build new kind of internet-based services and products. So that's a clear answer to why now. You could not have done this 2 years back because there were just not enough internet users. You can do it today because now there are internet users. Another answer can be computing power. If you're doing something around big data, AI, you could not have done this maybe 3 years back because, the infrastructure was not there, the technology was not there, but now because, the technology is there, you could do it now and you can capitalize on this opportunity. So I think thinking about why now is a really important question for both entrepreneurs and VCs when we look at investing. So these are the macro parameters. This has got nothing to do with you. This is nothing to do with your business, but this is macro, like how we think about the market, competition, timing, and we have to be convinced that these are all the right things right now before investing in you. So that's number one. Parameter 2 out of 3 is team. So you've heard this, that team is really, really important, right? So the question we're asking ourselves now is that can this team build a large company? Because it's hard to build a large company. It requires a lot of commitment, hard work, and a lot of skills. Like, do they have the vision? Can you do the storytelling? I mean, what we've seen is that storytelling is equally important as execution. There are many entrepreneurs who are very good at execution, but they're not able to excite people with their story, with their vision, and they're not able to find investments. They're not able to attract people, they're not able to attract investors, so I think the whole, a visionary entrepreneur who can tell a story in a very compelling fashion is a huge asset and very, very important for early stage companies. Execution ability. Does the team have the ability to execute technical skills, right? Because we do only technical investments. So we look for founders who have the technical skills, because it's very hard to hire technical skills very early in the game. So ideally we look for founders where, let's say there are 3 founders, one of them is technical, one of them is like the CTO, one of them is good with marketing, one of them is good with operations. That's a perfect team, for example, right? So complementarity in the team. Does the team complement each other? Can they work with each other? And can the 1 plus 1 be 3 and not 1 plus 1 just 2, because they're all work together much better and come together much better. So this is the second parameter out of three, which is team. That can this team build a large company? And and different VCs look for different ways to validate that. Can we work with you? Do we have chemistry with you? Do you listen to us? But do you have your own mind? Do you also have your own opinion, or you only listen to us? It's a lot of soft factors like this, but team is extremely important. The last parameter, which is parameter 3 on 3, is traction. So, is there some proof point of specific success? So, like for all early stage investors like us, we invest, for example, like $1 million, million and a half, $2 million maximum, right? So, this money is usually not enough for you to last forever, right? It will only last you maybe 1 year, 2 years maximum, right? So how will this money be utilized? How will 0 to 1 happen? There is a book Peter Thiel wrote, right? 0 to 1. Some of you might have read it. But 0 to 1 is a very different problem from 1 to 10. When you're trying to start something from scratch, from zero, then there is just a very different approach you have to take. You have to apply a certain hustle, and make things happen. So we have to be convinced that how 0 to 1 will happen, especially using our money, because our money is being used for that. You know, we try to study what has been achieved so far. So, for example, if it's a consumer app, even if it doesn't have revenue, we may look at, how many downloads are there, daily active users, monthly active users, DAU, MAU ratios, beta customers. Do you have early customers if you're a B2B customer, pilot customers and things like that. And lastly, we ask ourselves a question that will our capital be enough? Let's say you're doing a business which requires $10 million, but we can only put 1 million or 1.5 million, then the business will be undercapitalized. Even if we invest in you, we are setting you up for failure because you just can't make enough progress with our capital. So it has to be such a business where using our money, $1 to $2 million, you can make enough progress, so that you can raise the next round of funding. Otherwise, we are basically just investing in a company with no future. Ultimately 1 year back, you will not have made enough progress. We will not be able to put more money in you. Nobody else will put money in you. So it's a wasted effort and time and money for you and for us. You know, so this is third parameter, traction. So three important parameters: macro, which is market; second, which is team; and three, that is traction. I think broadly these are the three things that we look for when we are investing in a fund. Now, the last slide I have, and after that we'll just open up to questions. Is what are some of the tips and techniques? Because the topic was how to raise funds, and I've been talking more about what we look for, which is hopefully useful. But here are some other tips and techniques. Many entrepreneurs ask us, when is the right time to start? Should we start fundraising now? Should we do it once we have some traction? Should we do it 1 year from now? We always believe that the time to start is now, because fundraising is a continuous process and it never ends. Like in modern companies, if you are succeeding, you always need more money, because you want to grow even faster. If you're not succeeding, you still need money because you need money to survive. If you're very early, you can raise smaller money, you can get angel capital, things like that. If you're growing nicely, you can raise institutional capital like venture capital, you know. But it's very important to really treat the investors, the angels and the VCs, as a part of the ecosystem. So because they give you very valuable feedback. So if you keep talking to them, if you keep pitching to them, then you'll keep getting some feedback which you can incorporate in your business. Otherwise, imagine, let's say if you're building a business and you never talk to your customers, right? You will never know what the customer needs are, right? So you have to talk to your customers to get a better sense of what their needs, right? And then you build your product accordingly. Similarly, if you don't talk to investors, you'll never know what they're looking for. You'll just assume that they may be looking for this or looking for that. But it's only when you engage with them and when you talk to them, you will have those meetings and you'll understand what they're looking for. And you can tweak your business model, you can tweak your product to make it more attractive to investors. So I do feel the time to start is now, and it really never ends. The second point is cast a wide net. Don't sort of meet only one VC or two VC or two angels and get rejected and feel bad, because it is a service industry and different people have different views. some will be very negative on your business, some will be, only little bit negative, and some will be positive, right? So meet enough people, meet 10, 15 VCs. And again, I'm not fully aware of what the local ecosystem looks like, but I'm sure there are multiple venture capital firms locally or internationally which you can approach. So I think meet enough people. Also, the larger firms like Sequoia or Axel or Lightspeed, Matrix, they have multiple partners, and multiple partners also behave differently. So know who to go to. For example, some partner might be very strong with B2B investments, some other partner might be very strong on B2C investments. Some might be very strong on fintech investments, somebody might be doing more brand investments, somebody might be doing solar investments, right? So you have to basically spend a little time studying the firm and make sure you're going to the right person so that you're getting the right feedback. Otherwise, you just get, go to the wrong person, you'll not get enough attention, and all that good stuff. So basically, go find the right partner. Third point is that the only way to really know a VC is to study their portfolio. Like many people ask us, what do you invest into? And honestly, it's very hard to answer this question. It's a little bit like love, right? I mean, like, let's say if you're looking to fall in love, then what do you look for? Can you really make a list? I know some people make a list, maybe good looks, sense of humor, something like that. I don't know, but similarly, as a VC, it's very hard to make an objective list of what you look for. But once you see it, you know it. So it's a little bit like that. Again, when you fall in love, you know it, right? That you're in love. But till you're not in love, you can't decide in the morning that today I'll fall in love, right? And I'm looking for these things. So it's a little bit like that, right? So you have to sort of, sometimes you spot opportunities which you really like, and then you get into them, right? So the only way to really know a VC is to study their portfolio, spend some time studying their recent investments, last 12 months, what investments they've done, and that'll give you insight into how they're thinking. It's also the best way to approach a VC through their portfolio companies. So if you can get in touch with some of their portfolio companies, maybe they are friends, college buddies, and things like that. And if they can refer you to the VC, that's a guaranteed way to get a meeting at least, because VCs love their own portfolios, and when they refer people, they always get the highest priority. And last point I would say, is that close fast. Don't keep waiting for the best deal or the best money. I think in most markets, maybe except for Bay Area, most other markets, the supply demand equation is still skewed in the favor of the VCs. There are far more companies than there are VCs. So I think don't keep waiting. I've seen some companies keep waiting that, no, maybe we'll get a better deal, or maybe we'll get a better VC. This is a continuous process. If you're getting a deal, take it, move on, use the money, build the business. You can always go back 3 months later and raise more money. The value creation cycles have really, really shrunk. So I think these days, companies go back for fundraising within months. Earlier, it used to happen after like 12 to 18 months. These days, we see companies going back within like literally 6 to 9 months, to raise more money. So I think these are a few tips and techniques on the sort of just the how part of it, right? How to sort of go about it and all that. So I thought it might be useful. But let me pause here. I think that's all I had, at least from my slides perspective. And I think we can use the rest of the time for Q&A.
I mean, thank you very much for this great presentation, Rajul. And I have my questions before we pass to our founders. I mean, what are the common 3 mistakes that you have seen from the entrepreneurs that pitched to you from your own fund and also the fund that you worked before establishing your fund?
So I would say the number one mistake is that sometimes what founders do is that they're trying to create a sense of urgency, for a VC to make. And they many times they lie that we have another VC, that sort of that we are about to, this will go, within a week or within 2 weeks, And this is a mistake because most VCs say that, all right, we'll just wait 1 or 2 weeks, so if you're getting another deal, it's fine. So most VCs don't really have a FOMO, a fear of missing out, because they have a lot of deals. It's very, very rare that it's a hot deal and everybody wants to come in. That's 1 in 100. For most deals, there's no FOMO. And when founders lie about it, what happens is that when nothing happens in 2 weeks, then they have to come back and say, hey, my deal didn't happen. And then they create negativity, around that. So I think this is one common mistake that we have seen. So just be honest, every VC takes their own time. No VC can take a decision in one day or, 2 days. They need their time to study, your business, and give them time that, I mean, plan enough time so that, they can spend 2, 3 weeks, meet you a few times, or make their view, without sort of without an artificial pressure. So
Mhm.
that's number one. I think number two mistake is just around the market itself. Like many markets are just not venture investable. Like I'm seeing, for example, one of the Q&A question is around solar energy. And solar energy is a very good market, but solar energy in general is an asset heavy business, and it's not a venture investable business. So VC is a very specialized asset class which is looking to leverage their dollars many times. So we are looking for businesses which are asset light, ideally tech businesses which can scale very quickly. And I think a solar asset business, for example, is better for private equity and not for VCs. So know like what are the right kind of businesses which are venture investable. Otherwise, you'll just be wasting your time with the VCs, right?
Mm.
And thirdly, I would say the third mistake is we get a lot of common cold emails. Like somebody would just from our website write us a cold email, and we accept cold emails and we go through all the cold emails, but some of them are really poorly written. Like, I mean, one, you're writing a cold email, then you should take an extra effort to make it attractive. Otherwise sometimes they're really bad, and even if it's a good business, they don't get any attention. So either you go through referrals through portfolio companies, or spend the time, to create an attractive email, so that you get some attention. So I think those are the three most common mistakes, I would say.
Mohammed from the Solar Energy Founder has another follow-up question. What is the critical and most important points that a founder should mention and talk about during their pitch?
So I think the ability to build a large business, over the next 6, 7 years, like I said, I think most VCs are looking for large wins. you know so how your business will translate into a very large business, over a period of time. And by large, I mean ideally potentially like $1 billion businesses, or very large, like if you're in San Francisco, that bar now has moved to $10 billion these days. VCs are looking at decacorns. Even unicorns are not good enough, right? But I think if you're in India and if you're in Europe, I assume in Istanbul, if you can create businesses which are at least half a billion to 1 billion in value over 6, 7 years, I think that is a very important. So I think paint a picture of the future of how this business is going to become this large, and make it believable. Like, for example, if you're selling, if you're making solar plants, for example, right? Then how many solar plants will you need to make a very large business? And if it's too many, how much capital will that need? Is it operationally possible to make that many? So I think creating that belief, is it capital efficient? Because VCs are looking for high capital efficiency. So all those questions. But what does it take to get to a very large business, I think, is the number one question that VCs have. I think profits, revenue, especially, I think these are secondary level things. Profits come much later. VCs are okay taking losses for the first couple of years, first few years. They're okay taking losses as long as they know that, over a period of time we can make profits. So I think growth and largesse of the business is the most important thing. That's it.
And my question is, should you also mention about the maths of a VC? I mean, which means the fund has also its dynamics. So, I mean, most of the startups probably are not aware of the details of the mathematics behind the curtain of a venture fund. Should you roughly tell about us how the VC works?
Sure, absolutely. So there are, by the way, a lot of articles on Google, internet. Like if you Google how the VC math works, it's very well written about. You'll find thousands and thousands of articles. But let me try to summarize it. See, basically, think of us like from one fund, we'll make 20 investments approximately, right? And the VC hit ratio is quite low. So chances are that from 20 companies, if you're lucky, then 7, 8 companies will provide no return to us. They will just die and they will be zero, right? Chances are that 7, 8 companies will return some money to us. Some will become 2x, 3x, something like that, right? I think most of the returns are concentrated on your top 2 or 3 companies. So there is something called Peter Thiel's law, Thiel's law, power law. You can Google power law by Peter Thiel. So Peter Thiel predicted, he's the legendary Bay Area investor. He predicted that your number one company returns you more capital than the sum of all your other portfolios. So let's say if you are in 20, right? So our number one winner will give us more money than the sum of the remaining 19. you know our number two winner will actually give us more than the sum of the next 18. Number three winner will give us more than the sum of the next 17. You follow what I'm saying? So basically VC business is about finding large winners. We don't worry about losing companies or that some companies die, but it's very important for us to find large winners, because the large winner pays for all our mistakes. If we, like, for example, when I look at my angel portfolio, I made 28 investments. The number one company that I have has given me 72% of all the money that I've made from all the 28 investments. So if that didn't work, the whole portfolio would be a failure. So in general, because of that, as VCs, we're looking for large wins. See, at a portfolio level, we are still making 25%, 30% returns. That's what we are targeting. But to get there, we need 1 or 2 companies to really outperform. We can't get there with like 2x, 3x, 4x kind of returns, because some companies will fail, some companies will not even get 2, 3x. So if our best companies are only giving us 3x, that will not work for us at a portfolio level. Hence, every time we invest in a company, we look for large winner. So when we are making each of these 20 investments, we are asking the question to ourselves that can this be a large winner? You know what I'm saying? So that's the bar, and that's how the VC math works.
Probably that is also the reason behind that. When you invest a company, you expect most of them will also have a 10x multiple at the end of the investment period. And that may be also creating a pressure on the founders' shoulders, because VCs asks more returns probably, but some of them cannot do that and fail, but some of them probably returns more than 10x and cover all the portfolio's loss probably. And the reason that VCs work like that is the portfolio mathematics behind these returns. So probably some of the entrepreneurs do have very few knowledge about this formula. So it is always better to know each other. Expectations, I think, before doing the investment.
For example, let's say if a company pitches to us and they say, look, we are a very good company, we are profitable, we are revenue producing, and we are giving you a guaranteed 3x return, in 6 years, let's say, we will not be able to invest in it. And the entrepreneur will be like, are you crazy? I'm giving you guaranteed 3x return, right? But it doesn't move the needle for me. Let's say I have a $50 million fund, right? Mm-hmm. Now I have to return, I'm looking at how I can return 150 million or 200 million at a cumulative level, right? For the entire fund. If I invest 1 million in you and you give me guaranteed 3 million, that does not move the needle for me, right? To get to 150, 200 million. I need wins which give me 20, 30 million, 50 million, right? So I think that's the reason. And many entrepreneurs get frustrated that how can this be that I'm giving like a, guaranteed 3x return, but these guys are still not investing.
All right. Let's move to the other question from Ernest, San Jose. You mentioned that as startups and entrepreneurs should pitch more VCs. However, our challenges, we have limited connection with VCs. Can you suggest how we can get network with these VCs? And I also add his comments, especially in pandemic pandemic days, because early days last year, it was probably the conferences, physical kinds of networks would be getting value with creating networks, but also please take into consideration how should the founders may create new networks, especially everything is online.
So I would argue that actually the pandemic has made it easier for you to approach VCs, because earlier, let's say if you think of the Bay Area VCs, they would never meet any entrepreneur outside of the Bay Area, because they had so many choices, like in the Bay Area, in San Francisco, almost every pin code has so many VCs, right? That the entrepreneurs would go to just that pin code, because there's so many VCs and so many entrepreneurs, right? But now, because of the pandemic, everybody's online and entrepreneurs are coming out of everywhere. I saw a study last month where now there are more entrepreneurs coming out, many more entrepreneurs coming out of other parts of the US, like North Carolina, New York, obviously Boston, Chicago, where earlier much fewer companies were coming out, because now, people can be based anywhere. We see the same phenomenon in India, we see the same phenomenon in Europe. So I think it's much easier to attract VCs at this point of time than it was. What I have found the best channel is LinkedIn. So I think most VCs are very active on LinkedIn. And if you approach them on LinkedIn, I think most of them will respond. But you have to create an attractive email. I mean, you can't just be very sort of, careless about it, that you write anything. And like, for example, I would get an email message as, "Hi, how are you?" I will never respond to that, right? I mean, like, I don't want to start a random conversation with a random person, right? But I think if somebody gives a little bit thought to their message and it sounds attractive, I will always respond and we'll have a conversation. I think, even their direct websites, I think many VC websites give a very clear email address of the partners. And I know we feel that people don't respond, but in my experience, most people respond, if you write to them. So I would say don't be shy of that. And especially during the pandemic, these are great ways of getting out to people: LinkedIn, direct emails, of course, referrals. Look at other companies that they funded, reach out to those founders on LinkedIn, even if you don't know them. And, founders are usually happy to help other founders and they can refer you and stuff like that. So use all those techniques.
So the next question is, Hiba Kardash, what is the largest share of company we can offer it to investors? I mean, Hiba means probably in early stages, what is the largest share that the startups can offer to the investors?
So Hiba, all investors work in a very narrow range, of parameters. Like, for example, our parameters are that we will invest approximately $1 million. Maximum we'll go up to 1.5, minimum is 1, so usually 1.2, 1.3. And we'll always take approximately 15% of the company, 1.5. The minimum will be maybe 12, maximum can go up to 16, 17. We will never go out of these parameters too much, and if you don't fit into these parameters, we'll not invest in you. If you're too big for us, then we'll say you're too big for us. If you're too small for us, we'll say you're too small for us. So I think every VC like that has a certain parameter in which they invest. Most early stage VCs never take more than 20%, and I would say they never take less than 10%. So that's kind of the range between 10 and 20. Maybe the median will be 15. Some invest 1 million for that, some will invest 2 million for that, depending on the VC and the stage that we invest into. But it's called significant minority, but seed level 10 to 20% is normally the range investors take.
And following the question, I also wanted to ask you another question. When you find the cap table a little bit mixed and crowded, what do you do?
So there are many solutions to that. I think, for example, sometimes what happens is that a company might have raised angel money and there might be 20 angels, each of them might have put in $5,000, $10,000, and, you have a crowded cap table. There are many ways of solving that. You can always give like a power to the founder who can sign on these angel investors' behalf. So I think institutional investors through the agreements can take some of the rights away from angels. And it's not for anything evil. The reason is that, as the company gets bigger, you can't keep going to 20 people to sign every small document. So you can create rights that one person can represent those 20 people together and become the signatory for them. These kind of solutions are there. Sometimes you can create small LLPs or partnership firms where you bunch in all these angels, and then that becomes one entry onto your cap table. I've also seen things like secondary sales. So what means is that as an investor, let's say we buy out 5, 6 small angel investors as a part of the round, so that cleans up the cap table. So I think there are many ways of doing it. My What I've seen is that if an investor really wants to invest in your business, they will find a way. This will not stop them. They'll find a way to clean it up. I think if there are other reasons that they don't want to invest, then obviously they will not invest. But there are ways to clean up these things.
Great answer. So Ismot Jahan asks two questions. And if there are many competitors in the marketplace, how can they create a space? I mean, if they are active in a red ocean, which means there are a huge competitor and rivals, so what should they do? I summarized the question. And if the team is not sufficient, I mean, so I think this is one of the common questions especially in early stages. I think team is not always sufficient, and team is always small. What should they do? And I think also he's adding financial problems cannot change the team.
Right. Well, that's a lot of problems, by the way. But let me answer them one by one. So on the competition, look, I think if you are in a market which is very competitive, let's take an example. Let's say the taxi market, right? Uber is there, and like every country has its own local. Like India has Ola and Uber, which are the two big players. Like US has Lyft and Uber, and every country has their own this thing. So I think if you really want to start another business in this space, then you have to find some niche, some angle to it. For example, in India, another company started an Uber for school children. So they basically said that, okay, we are specialty meant for school children, to drop them to school and come back. And that use case requires a little bit more safety. Normal Uber drivers cannot be trusted with that. So we do a level of check. It's a little bit more expensive, and they did quite well. And then they got bought out by Uber, later on, right? So I think you have to find a niche which helps you succeed. Like for example, in e-commerce, you can't just create another Amazon, right? But you can do vertical commerce. Like for example, there are many companies in India which have, for example, created an e-commerce just for beauty products, for perfumes, lipsticks, and they have a lot of depth in that, and they've done well over a period of time because they have a lot more depth in this segment. Or for example, somebody else created a craft crafty kind of products, right? Like which are regional products, which you don't get easily. So then a company called Craftsvilla, so they did very well. They grew. Or for example, Meesho changed the distribution. Instead of doing e-commerce, they did social commerce, where they used all the influencers to recommend products. So you have to find some angle, right, and some niche, either vertically, horizontally, regionally, distribution wise. You have to do some innovation that you can compete. You can't immediately copy exactly what is working, because nobody will fund it, and it'll cost a lot of money, and there's no reason why you will succeed. So hopefully that answers your first question around competition. you know the second question around, if you don't have a complete team, this is a big problem. And also, if you don't have the money, like you said, right, sort of you're running out of money. I think, look, founders, one of the key skills that they need to have is to sell their idea to other people, you know and that is very, very important, because that never stops. You have to sell it to your co-founders, you have to sell it to investors, you have to sell it to customers. So most founders, when you bring in other people, if you don't have money, you give them equity, right? You give them shares. So you give them 20% of the company, 10% of the company, 50% of the company, depending on how valuable that person is, right? So if you don't have cash, then you have equity, and you have to have the vision to sell that equity at an early stage to other co-founders and complete your team. So that's how most people do it. And then then they go back to VCs and raise money. but you do need a more complete team. I mean, it'll be very hard for VCs to fund you if your team is very incomplete or looks very raw, for example.
What is the average size of the shares that should be allocated to the employees pool? Do you have an average mean in your portfolio, or is there a standard market standard?
Sure. So after we invest a seed round, so after we invested, let's say $1 to $1.5 million, normally we would create an ESOP pool of 10 to 15%.
10 to
So the minimum is 10, maximum is 15 again, I would say. And this again depends a little bit on how many founders are there and how many positions need to be filled, but I would say 10% is the minimum, because we want you to attract other people, offer them incentives, offer them stock, so that they treat the company as their own. So the range is 10 to 15%.
Mhm. All right. Next question, Arvin Torres. You mentioned earlier you have 3 out of 28 early investments did really well. I understand it will be different from VC perspective, but how would you describe the right mix of market, team, and traction for you as an angel investor and you as a VC?
I think the main thing that changes between an angel and VC is traction. So the market is still the same. We would still do the same amount of evaluation that can a big business be built. All the same criteria applies. Whether you're an angel or a VC. The team sometimes is a little bit more complete when you're investing as a VC, because you're coming in a little bit later. These companies are maybe 6 months, 1 year old, versus an angel sometimes have invested, literally at an idea stage. We're just sitting in a restaurant, having coffee, and I committed investment. So it's angels can do that because it's their own money. I think the traction is very different. So in most angel cases, most of these companies were pre-launch and pre-traction, so there was no proof point to study. But these checks were also small. These investments were like 200K, 300K, between multiple angels, right? But because as a fund we are making larger commitments, 1 million, 1.5 million, we need to see a little bit more proof points, a little bit more product market fit, a little bit more traction. So that is the main thing that changes. I would say that is the main thing that changes even between us and Series A. Let's say when you go to raise 5 million, 10 million, then again, I think market and team considerations are very similar, but traction changes. They want to see a little bit more traction, some revenue, like breaking out, fast growth and things like that. So traction is the main thing that keeps changing.
And also we have many questions, but I'm selecting some of them. We have limited time. So what is the eye-catching pitch deck advice for the startups? I mean, how can they prepare a presentation which should be also interesting for the audience they are pitching? And what should be the results after they do 2.5-minute pitch?
So, what is called commonly as the elevator pitch, right? The elevator pitch is usually like a 2-minute pitch, the time that it takes for an elevator to come down or go up, right? So the only result that you're looking for from an elevator pitch is that somebody gives you a meeting. There is no other purpose of an elevator pitch. Nobody is going to invest just on the basis of your elevator pitch. So it's only to excite people to give you a meeting. Usually things that excite people at that level, at an elevator pitch level, is a very clear identification of the problem they can relate to. So like if you can visualize, if you can help visualize a VC, that this is the problem I'm solving, and this is how it will make your life better or somebody's life better, in a very visual way, and if you can convey a lot of energy and passion that you feel behind that, and if you can convey that this is a large problem to solve, I think those are the 2-3 messages that you can convey in a 2-minute pitch. But the only purpose of that is to get a meeting, and the meeting will be much more detailed. The meeting will be a 1-hour meeting, right? So then all the other things will come in. So elevator pitch is really only the start, and it's not the finish, but it is an important start, and it gets your meeting.
And I mean, in the presentation, what do you look to be default on the pitch deck? I mean, for example, are you looking for the market size competition, or if a team slide is missing, how do you give a response to the startups?
So we are looking for those same three things that I talked about: market, team, and traction. So whatever details you can provide on that, I think that's what we are looking for. Like if a team slide is missing, that's a big miss. Like because we are investing in the team and we need to know who the team is, right? So I think you need to build some credibility with us, right? That this is what we've done, some history of success, some history of working together. Maybe it's a good institute, maybe it's an earlier startup, maybe you work for a top tier company. So you have to build that credibility, and create, impress us that we want to be able to work with you. So team is very, very important, but market is very important too, and traction is very important too. I think so a complete pitch ideally has all these three things.
Did you invest a startup without any traction?
Yes, as a VC, we have invested in startups without any traction as well. So I would say out of the 22, there will be 3 or 4 like that. When that happens, one, the team is extraordinary. So we may know the team from the past. Like for example, it's a serial entrepreneur. Somebody's created $1 billion company before. This is his new startup. So then everybody wants to invest because they feel that this person has done it before. That's a big deal. Sometimes the space or the product is very, very attractive. Like for example, we invested last year in a company which is in the video commerce space. And in India, that's just a big space. People are selling through video. It's a very hot space. And it was a very good founder. So we invested pre-revenue. There was no app, there was nothing had launched. So I think you usually need those two things: a really hot space and a really good team. If you can bring them together, then investments can happen before revenue as well, before traction as well.
I mean, Rajul, thank you very much for all the questions, answers. We have many questions, but to sum up, I have also a couple of last questions about the fund. What is your ticket size? Where do you invest? And what should our founders should do to connect you after this meeting?
So we invest between $1 and $1.5 million. That's our sweet spot. We invest in India, Southeast Asia, and US so far. We have never invested in Europe or in the Middle East or in Turkey, Istanbul. But we are looking at companies in South Asia. Like for example, somebody I saw was asking about Bangladesh. We have looked at a few plans from Bangladesh, and because these things are following India, so we can see some of the successful models from India can be implemented in Bangladesh, or Sri Lanka or Pakistan or some of these places. So we do look at these ideas as well. And the best way to get in touch with me, I gave my email on my slide, rajul@leo.capital. Feel free to write on that. Feel free to connect with me on LinkedIn as well. I'm very open. I'm happy to sort of talk to you. And I'm also learning all the time. This is the main way we learn. So I'd be happy to connect with you.
Rajul, thank you very much. Your valuable time and expertise and this content, very much appreciated. And have a great night and stay safe and healthy.
Thank you very much. I greatly enjoyed the conversation, and my very best wishes and good luck to all of you entrepreneurs. And I hope you do the very best. And thank you, Burak, for inviting me.
Bye-bye.